Welcome to another episode of Millennial Investing Explained. Here's today's question. All this talk about price, that provides an interesting segue to the next strategy that we're going to talk about, and that is growth investing. And the reason it's so interesting to segue into this is because those who invest in growth strategies don't necessarily put a lot of weight on the price they're paying, which kind of goes against everything that we just talked about. Companies like this are great in bull markets like they have been over the last decade, but they get hit very hard when the economy slows down and the stock market takes a turn. I know you're a value investor, Preston, so I'm really curious to hear what you think of growth investing.
I don't think anything negative of growth, to be quite honest with you. I think that it's a strategy that can work for certain people. I think it's something that absolutely probably has more risk just because of the volatility. If you're dealing with a smaller company that is growing rapidly, sometimes that can be a wonderful thing, especially if there's not a lot of competitors in the space and they're kind of first to market. There's a lot of considerations that you have to take into consideration to trade this type of market well. I would tell you, you have to really, really do your homework. There's also kind of this, I would argue, this kind of dynamic over the last 10 to 20 years where you can get very large growth companies. I mean, Amazon's a great example of just a mammoth company that I would consider a growth company when you look at the top line and the percent of how quickly it's growing. And so you got to ask yourself, is that something that's going to be easier for me to project and understand when you're dealing with such a macro size business that I'm going to be able to exit the position maybe a little bit easier without such the hit that you'd get with a small cap company that has a new competitor that enters and their growth just literally gets splits in half, and then your stock price goes down 70 or 80% in a single shareholder's call. Those are the concerns that you run into with growth, is if the top line does not keep pace with, and when I say top line, this is the sales of the business. This isn't the profit. This is the money as it enters the business before any expenditures are subtracted out. So when I say top line, that's what I'm describing. People that do a growth strategy, they're really paying attention to that top line and how quickly the company's growing. And if they miss any semblance of that growth rate, the company is just going to get hammered. So I think people can do this successfully, especially people that are really well versed on what the product or the service is that the company is providing, and the competitors and the market size and the growth rate of the market. You know, have I done growth investing? Absolutely, I've done growth investing. I don't do it nearly as much as some of my other strategies, but it's something that I have done, and I've only really kind of entered it into areas where I feel like I understand what I'm getting myself into. I'm not just going out there and trying to find growth companies and just then buying them. I'm trying to participate in areas that I feel like I understand them well.
I think it's important to note that most of these strategies are not binary. You are a value investor, Preston, but as you said, you add aspects of momentum, and you've also done some growth investing. So you can certainly mix in multiple strategies. Maybe you want a value strategy. Maybe you want a value investing base with a small percentage of your portfolio allocated towards growth picks. It really just comes down to what you're most comfortable with and what you understand. You don't want to invest in high-flying tech companies that make you lose sleep at night and that you don't understand. But if you find a high-growth company that you believe in and understand really well, and you want to allocate a portion of your portfolio to it, I say go ahead.
So let me just provide an example to just shows you how difficult this is, but how people that are implementing this, maybe buying at 200 times sales, come up with a justification in their mind. So let's talk about Tesla. When you look at the market cap of Tesla, the company is priced at the same value as like GM and Ford and these. I think the market price was as high as like $60 billion, which is just huge for a company that's only manufacturing the number of cars that they're manufacturing. They're just like not even at like, and I don't know the figure, but it's around like 1% or 10% of whatever these other companies are producing as far as cars. So why would somebody pay such an enormously high multiple, fully knowing that there's no way they're going to take that much market share away from those companies? I would argue, if I was just going to play devil's advocate and try to argue on the side of how that valuation could get that high, I would argue that in the future, autonomous driving vehicles are going to come down to a really, really important question. Is this software load the safest software load based on 1 million+ hours of driving? Okay, that's what people in the future, somebody from 15, 20, 25 years from now, what they're going to ask themselves whenever they get into a car is, what software baseline am I operating on whenever I'm riding in this vehicle? Am I riding in the GM software load, which is statistically proven to be the safest software load? Am I riding in the Tesla software load that is hands down 5 times safer than any other artificial intelligence-based driving system? I believe that what you're going to find is some company is going to emerge as the safest software load, and then it's going to be licensed to all the car companies. The car itself is going to be completely commoditized, and it's going to come down to who can run the safest software load. Because a lot of that's going to come down to the design of a deep neural network, machine learning based model. It's going to come down to who has run the most data through that deep neural net to come up with the prediction model that's giving such safe results. All of that stuff, I think, is going to come into play. And so if that scenario plays out, now all of a sudden we can kind of understand why a Tesla company could be valued so high if everybody's got to run that software load in the future and all that licensing that's going to be associated with it. Now, as I say all of that and I basically build up this argument for how a company could be valued so high, in the same breath, I'll tell you, none of that has happened at all for any company. Who is leading that charge? Well, you could make the argument that it's Tesla. You could make the argument that it's Google, who's not even really in the car business right now. You could make the argument that it's whoever. And I would put the probabilities of any of those arguments being pretty comparable to probably the top 3 or 4 companies that are out there, which could even be Chinese companies because they're probably going to run a whole lot more data than any US-based company in the future. But to be able to say that one of these companies is going to emerge as the winner at this point in time, I would tell you, you are doing some really fancy numbers with your statistics on your projections and your probabilities. So you get into these really deep intellectual arguments with people really, really fast when you start talking about growth companies, and you really got to understand what you're talking about. And not only do you have to understand what you're talking about, you have to understand the statistics associated with what in the world you're talking about. And so I say all of that to just try to give people an appreciation of how hard it is to really kind of understand what the future holds, especially when you're dealing with a company with a really high growth rate and a really high premium that's being paid in order to own the equity of that business.
To take it even a step further than that, not only do you have to understand the statistics and understand where the business is going, but you actually have to be right. We can think we understand the statistics and where the business is heading and all of that, but we could be dead wrong, and then our position is completely blown up anyway. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.